Hello, everybody. This is 𝗁𝗵𝗶𝗀 from Insurance Advisors Direct, and we are here today for our product launch of group benefits. And we have our special guest today is Spencer Berg from Allstate Benefits. He's going to be telling us a little bit about what they do, what the offerings are. Housekeeping, we are recording this, and I will follow up and we'll get information sent out to you. There is a lot of information to absorb. We also will be having an additional training course for those who get contracted coming up in the next couple of weeks. So everything you hear today, don't fear. We will be sure that we we put that into an extended training session coming up very, very soon, as we are upon open enrollment on the group side as well. So just to add one more group thing. If you do have any questions during the presentation, please put them in the chat or the Q&A function. We have everybody muted and off video just for the sake of time and consistency. And all right, so without any hesitation, Spencer, I'm going to let you take over.
Awesome. Thank you so much, Tammy. So what I'm going to start with is sharing my screen. As Tammy said, my name is Spencer Berg, and I am the Senior Sales Executive with Allstate Benefits and handle the small group health, level funded or partially self-funded offerings. So can everyone see my screen? I'm going to assume so, but
yes, we can.
Just to be safe. So first and foremost, I have been doing this for about 13 years. Allstate Benefits, this isn't a new product. Allstate acquired National General. We were previously Assurant Health before that. So we've been doing this, and we were the first, major medical stop loss to actually go out and offer level funded to the market. And that was back in 2012. There was obviously some TPAs for those of you that are familiar with the group side that did some similar arrangements, but we were the first major medical stop loss to do so. So with that being said, I'm going to get started on this and go over a high level of what level funded is, why you would want it in your product portfolio, and the advantages, disadvantages that you need to be aware of going forward. So for the first slide here, we're going to just go over this on a high level. What are the level funded group health plans? So these are policies, right, that are empowering business owners to really take back control of their healthcare costs and their EB package. Employers in the market today, their second highest cost is going to be their health plan, typically outside of payroll. Payroll will be number one. The health insurance will be the second. So what these plans actually enable employers to do, right, is to really take back control, like I said, and get rates that are proportionate to their risk, right? It is a strategy. It's the only real way or alternative to fully insured options in the market where they can get lower rates, increase the value of their benefit package, right? And then ultimately implement cost containment measures along with a lot of value-added features that really will help the performance of the group and the utilization in the long run. Not to mention with the trend of what we're all seeing in the healthcare space, since the rates are proportionate to the risk, this also enables them to stay in front of and beat that healthcare trend. Whereas on community rated, you're basically, or fully insured, you're basically stuck with how that whole block is performing. So what you're going to see here is that it looks and feels the same way as fully insured to all the employees. The only major difference is going to be that there's obviously some underwriting to ascertain the risk profile of the group, and the rates are going to be composite, meaning they're average, so everyone has the same rate. All right. And employers typically are always going to like that. I've already touched on the rates being proportionate to the group's risk. That's how you can save these employers 10, 20, 30, 40%, depending on what their situation is and how many employees are on those businesses or in those businesses. The best portion of this and what makes it so easy is that they're also going to have a refund potential baked into their premium. All right. And 2/3 of all these businesses are going to get some sort of refund back. Okay. And that just comes with the nature of the beast, with underwriting and being able to, like I said earlier, assess the risk of what's on there. And that's one of our strengths and has been and has obviously propelled us to continuously be on the list of purchases there, as I mentioned earlier, with Assurant Health, National General, and now finally Allstate Benefits. That growth has been compound between 15 to 20% over the last, well, my whole career essentially. All of these plans, just so everyone is on the same page, they're aligned with the ACA mandates and they meet minimal essential coverage. So that is the first and foremost thing that you definitely want to know. There is no actual liability on these plans, which is something that inevitably will come up in a question that will be asked, but you can be rest assured that there is no liability to the employer. Now, this is a great slide. I've had a lot of success with this over the years. This is illustrating the difference between fully insured and level funding, right? And what the main difference is that it's really, we're going to be transparent with the data that's involved, and we're going to be transparent with the employer's premiums. If an employer has a fully insured plan right now, typically it's going to be a sunk cost to the business, right? Regardless of if the employees use it, if the employer and, maybe a spouse are using it, no matter what, they're never going to get any of that money back, right? It's a sunk cost to the business. So what this slide is illustrating is the actual difference, and what I mean by that transparency. Usually you're just going to see one total premium on the fully insured side, whereas we're going to show you a total premium on the level funded, but we're also going to illustrate how we arrived at that premium, and we're going to show you the 3 boxes that really make this whole thing go round and what makes up that total monthly premium. And what makes it up is illustrated right here on this slide. Stop loss insurance, which is obviously Allstate. Everything is written on our own paper. Okay. So we are the stop loss insurer. That means if a business or an employee at a business has, a $5 million claim, obviously the employee and the employer are not paying that 5 million, right? The stop loss is going to be paying that. Okay. The administrative costs, we have a TPA that I will talk more about later. The TPA stands for third party administrator, and they essentially help make the product go round and run from the day to day. That could be from the online portals, their service teams, the adjudication of claims. Obviously, that's the main thing that they are doing. And clearly, they're also going to be paying the commission to the agents involved as well. The claims funding is actually what makes this work and go round, right? And you're going to see on here that it says a refund on the claim surplus after 6-month run out period. I will get into what that run out period is, but essentially what it does is it ensures that any claims that are incurred, after the 12-month policy, right, that they are adjudicated and paid out of that 12-month policy period. That may not make sense to a lot of people that are not, savvy or in the group health space, but rest assured, I'll definitely be able to make that apparent for you. The main difference that you'll find in the market too is that regardless of the renewal status, let's say they thought that they wanted to go to an 𝗺cie or some other option, right? Whatever is left in that claims fund still will be sent back to the employer. It is their money, right? So technically, we're going to send it back to them regardless if they renew. That is going to be the main differential between a lot of these policies and some of my competitors. Here, we just have a brief, illustration of the differences between fully insured, level funded, and a full-blown self-insured. I'm not going to spend too much time on this, but as you can see, right, on the fully insured, consistent monthly premiums. So everybody, they know what they're getting into, right, in terms of what their monthly premiums are going to be. But like I said earlier, it's a sunk cost. Regardless if the utilization is good, bad, indifferent, they're never going to see any of that money back. Not to mention where they could be rewarded on a level funded, let's say they get a 3% renewal on fully insured. Those are typically going to be the groups that we can save 20, 30% on easy, just because they should be trending the right way. For the level funded side, you'll see that I've got 2 smiley faces here in green. This is just illustrating that the surplus is obviously still available to them. Like I said earlier, it looks and feels like fully insured, but now they have equity in their plan, or the employer has some equity in their plan that's built into the premiums with no additional liability or cost. Full-blown self-funding is really not going to be a realm that we're going to talk about, but I do just want to make it apparent that level funded or partially self-funded plans are not the same thing as a true self-funded plan where the employer, is paying claims. And I can get into that in more detail, but frankly, what we're really going to be focusing on here is the level funded today. So the advantages of the level funded programs and why you would want to actually put them into your portfolio and sell these, right? So number one, we've already talked about it, lower rates. That is the name of the game these days. We've all seen how everything is trending. Employers, I'm seeing a lot of employers shrink over the last couple of years. It's getting to a point in a lot of these markets where they're basically between a rock and a hard place. They have to make the decision, how do we save money? And inevitably, it's usually the benefit package that they're going to try to tackle. So you can be confident that you have a program available to you, right, that can help facilitate and be a solution to a lot of those employers' needs. This is a little bit redundant, right? But a lot of times, since we're underwriting, the rates that we're going to be able to, get down, obviously, and save the money on, it also gives us room, right, to increase the value of their benefits. Most employers in the small group realm, they're not mandated to offer the insurance. They're offering the insurance to create value, right, and retain and attract new employees. And that also is something that we're seeing a lot of, and why so many employers across the country are taking advantage of these types of level funded programs. It's the best way to get the lowest rate for the best value plan, essentially. So obviously I already talked about the refund potential. I've talked a little bit about, building the equity and staying in front of the market trend for the healthcare industry. But really what these allow you to do too is that the renewals are going to be judged on that group's risk or their projected risk for the next year. That is a huge advantage because at the end of the day, some of these businesses, right, a lot of employers, you'll hear it, and I'm sure there's tons of people on this call that have heard this directly, they're frustrated because they spend all this money on insurance and they feel like nobody uses it. That is the perfect type of employer. That's the perfect type of situation for these types of programs. So if you ever have one of those opportunities come up, definitely share it with Tammy and I, and I'm sure we could put a solution together for you. I talked a little bit about the age bands and the rates being composite. That typically makes it easier on the HR person or the person that's running point on everything healthcare related for the business to relay the group health premium to the new hires and just to keep the math more simplistic. You get rid of the age rate tiers, which obviously is penalizing the older employees in the group health space. So that's a huge benefit. We have COBRA admin included, no charge. We also will set up the Section 125 admin docs. If anyone's ever looked into that themselves, they'll know that it's a little costly. So we do provide that documentation, and it's included on our employer paperwork so that they can facilitate and give that to their payroll company. That way, all the legal boxes are checked and they have what's needed to implement those pre-tax plans. CXC tool, technically, that is for the reporting software. The one major difference with level funded versus fully insured is going to be the reporting for the 1095s and the 1094s, right? So we have a tool on there with level funded, just with the way it's structured on paper. Technically, the employer has to facilitate and give those to the employees. It will literally take about 5 minutes. There's something on the portal. They'll just download the census, upload it to that tool, and it will populate the appropriate documentation. I have seen, and I've done this for a very long time, it sounds like that is one of the better tools or the best tools out there available in the market. So as long as the employer or the broker are relatively tech savvy, it should probably take about 5 to 6 minutes to actually provide that for them. And there's constant email communications that go out on this stuff as well. The 𝗁 Health, Papa Caregiver, Cancer Coach, Recuro Health Telemedicine Services, I'm going to get into that a little bit at the end here, but those are all value added benefits that we put on these that help emphasize cost containment and additional value there for the employer and the employees. Like I said earlier, they want to attract and retain the best talent. The only way to do that is really the differentiators becoming, what does their benefit package look like? So that's why we're really focused on the best value and finding the best solution and tailoring it for that specific employer. So from the broker standpoint, right, and I know that we have a mix of different backgrounds on here. So for the ones that obviously are more acclimated to group health and are very active in that space, this may not be as pertinent, but that still is relevant to a degree. So if, let's say you are a property and casualty agency and you're looking to expand into this, right? Or if you're just selling the sub 65 or individual medical, right? A good way, especially on the P&C side, right, is, and this is a trend I'm seeing continuously over the last 4 years. We have a lot of those value adds that I talked about on the slide earlier. The cost containment measures that are included on there can help stabilize and mitigate, workers' comp claims, right? Umbrella policy claims. That is one of the terms or one of the things I'm talking about when I say cost containment. If you can try to emphasize and proactively provide employees with tools for prophylactic treatment, it inevitably is going to help the business run more smooth and the utilization run more smoothly, right? Not to mention you're going to probably be able to nip a lot of the issues that could come up and turn into, let's say, a workers' comp claim. You could probably nip that in the bud very quickly by using some of those additional benefits that we include on all of these policies. And that's where the 𝗁 Health will come in. We will circle back to that. So another thing too is that this is an easy way to differentiate yourself, right? A lot of brokers, right, as the block grows, what happens is you have a less conducive model to doing medical underwriting. It's more of a churn and burn type of situation, right? Which inadvertently means, right, that some of these employers who could have a great solution in front of them, they don't necessarily see it, or it's not brought to them, right? And that's because it's just not conducive to some of these other, health-oriented agencies' focus in their business model, essentially. The other thing I would touch on too is that, especially with what's going on with the P&C renewals, and just in general with all sides of the industry, you want to have more product lines covered. Why? Because it defends the block, right? If you have more lines covered, there's less opportunity for competitive or competing brokers to go in and possibly get that business over yourself, just because they may have offered this type of program and maybe you didn't, or just maybe you weren't comfortable. That's why we're here. We will help make you comfortable with this. It's actually going to be a very easy sale for you guys, as long as it's a good fit. So this next part kind of goes into what I was saying too. Most large health agencies in today's day and age, they're going to require $10K or $10,000, right, an annual commission in order to justify working with some of these smaller groups. And when I say that, it could be a 40-person business. If a lot of them are going to base it all off fully insured commission, right? And they may not hit that 10K. Therefore, they can't work with that 40-man group. There is a vacuum in the marketplace for a lot of those sub 50 businesses. A lot of them are overlooked, or they're not seeing the solutions that they should be seeing. So there's a ton of opportunity for everyone to capitalize that's on this call available. And you're going to see, and really what I want you guys to do is, if these opportunities come to you, or if you have an employer, maybe it could be a friend, whatever the case, if they're pulling on your pant leg saying, hey, I would love, to look at something that can help me, keep this in line, save money, and implement cost containment, that's when you want to give Tammy and I a call, and we'll obviously help put something together for them, because odds are, if they're really struggling that bad, they may not have even looked at one of these before. They have no idea that they could save as much as they possibly could. Another thing, just because I do know that, clearly we have some people that are on the P&C individual sub 65, right? Lead generation. So if you're selling a lot of voluntary benefits, right, or if you're selling individual plans, right, this is a great way to generate leads too. Same thing with Medicare. There's inadvertently going to be leads that come up from these group products, and the referrals will really, in the long run, take care of itself, and it will only drive more business opportunities for all of you. So that is really a lot of the advantages from the broker side. And I didn't even touch on the competitive commission. So a lot of people stay away from the health because they think there's no money in it, right? We pay a very competitive commission on this. The street is going to be at 7%. It's going to be the same thing. So IAD is a great channel to go through on this because there's going to be no differentiation there. It doesn't matter if you went to direct or if you went through IAD and used all their resources. And that is flexible commission too. So let's say if we want to take it down to 5% or if we want to take it up to 9%, that is all possible and can be done. Every single one of these quotes and these plan designs, they're all created by me. We can customize it down to a T to ensure that we have the right solution for that employer. So I definitely want to touch on that as well. So all this probably sounds pretty good, right? Lower rates, better benefits, and the employer gets refund potential. So what's the catch? The catch is that since there's medical underwriting, not all businesses are going to be a good fit, right? There are some drugs out there that cost, $25,000, $5,000. A good way to think about it is that if you see a commercial for a prescription in particular, if it's a pill, it's probably $500 to $1,000. If it's a biologic or an injectable, it's probably anywhere from $2 to $25,000. And we can get into that in more detail if need be. But obviously with RXs that are that expensive, right? And if we're talking about a 10-man business and they're taking, $30,000 in medication monthly, that would probably be one of those scenarios where the group is not a good fit, right? Now, it's not the end of the world if it's not a good fit, because the way that you're going to position this, and this is the truth of the matter, is that it's impossible on fully insured to make data-driven decisions, right? Because there is no data, there's no transparency to a lot of what they're doing on the renewal side and how everything gels. So what ends up happening here, right, is that now that you have the data and you can see a lot of the risk that's in there, right, you can make the best possible, educated decision, right, to find the best outcome and solution for that business. So the employer can at least know that, hey, we did approach this type of scenario. We looked through it, vetted it out. Didn't sound like we were a good fit, this year. And that's all well and fine. The nice thing is that that's why ACA and fully insured is out there. It's always available to them. They always have that to fall back on. Sure, would the employer love to save money? Yes, it just may not be at that time. We can go and we can reshop these groups later on, especially once we know or we've identified that, maybe somebody quit, maybe somebody left that had all the risk before. That would be a great time to relook at it, obviously, just because if the risk profile has changed, then likely the results are going to change as well. Just a general tip, and this really goes, the bullet point on here says best to shop, fully insured policies every 3 to 5 years. In actuality, you should probably, gauge or at least gauge the market to reset the employer's floor, right, every couple of years. Why? Because there's no better time than now. And the best way is when you have these groups that are on fully insured or even level funded, right, and it's been 10 years, odds are medical trend may have caught up at that point. 10 years is a very long time. You do want to keep a pulse on what's going on in the market, and is the employer in the best spot, or do they have the best solution in place for their business and their benefit package? The most important thing is that the employer can at least have that peace of mind, right? That you've literally left no stone unturned. You're trying to find the best healthcare option for them. It just didn't turn out to be this. However, now you can tell them, and look, given all the data that we have, I can tell you with 100% confidence that this is going to be your best fit, right? So those data-driven decisions, that really does come into play. And that's a huge selling point of why these level funded plans are, a great option for these small businesses, especially in the current economic climate or market climate for the healthcare industry. So now I'm going to talk a little bit about our product and go through some of the niches that we specialize in and that we write a lot of. So really, 2 to 50 enrolled is going to be our sweet spot. Don't get me wrong, I've written 150, 200 person, businesses. Those come with the territory as well. But our real strength, right, is really underwriting the 2 to 100 enrolled, right? It's not, everyone thinks it's very easy to, assess risk in that space. It's not. That's why we've had the success we have in our margins and our products. Growth has basically outdone the market by 2 or 3 times. And all those numbers are obviously public. So you're going to have more success with 3 enrolled. And I can get into that in more detail, but just given time, I don't want to necessarily go down a rabbit hole with all of you guys. So I touched on this earlier. Every single plan, every single quote is fully customizable. In other words, we're going to fit it to exactly what the client's specific need is, whatever solution they're looking for. It could be lower rates. It could be we have a participation issue. It could be we want to do a carve out of all managers, right? There are tons of different ways to maneuver these. And the nice thing is since these are governed by 𝗺cie, there's so much flexibility in place that odds are there's likely a solution there that we can come up with for them. We're industry agnostic, meaning we're really not going to, discriminate or turn away any businesses. There was something that just recently happened. There's a few states where we're not going to be able to write non-𝗺cie groups. That's Pennsylvania. I can give you guys the states. It's about 3 or 4. None of them are really in the Midwest for now. But those non-𝗺cie groups would be like churches, Indian tribes, municipalities, just to give you an example. And really, like I said, for the most of the country, that's not applicable. It's only going to be for a handful of states. So multi-state businesses or groups, right, with employees all across the country, and they want to take advantage of a national network, right? So number one, there's discounts involved in that, just for having 3 or more belly buttons in another state. There's also discounts at 10 enrolling. So when you have those groups that are located, across the country, we can tailor options, right, that best fit the network needs for that group and those employees that are in the other states, right? And I listed a couple networks. I have a slide after this doing this, but I technically have access, depending on the market, from anywhere to like 6 to 8 networks. Primarily, we're going to stick with ASA or Cigna, since those have the best discounts and they are the largest, obviously, in terms of the breadth of the network. We also offer reference-based pricing options. That's always available. We can go through that. Certain markets are going to be better fits for that versus others. I'm also going to say, because I don't have it on here, but this is something that I'm always amazed to hear that a lot of people don't know. I'm just going to give you guys an example. Let's say you have a business location, right? It's a multi-state business. They have locations in 2 different states. We can either write it out of the state that's headquartered, right? So the headquartered state, or we can write it out of the state that has the most employees. That's valuable information to have, because there are certain markets, right, that have a very high average for their healthcare premiums versus others. So usually, if in that instance, like let's say we had something in Michigan and Indiana, Michigan's rates are always going to be much cheaper than Indiana. Indiana is one of the most expensive healthcare markets in the state. That's why there's so much level funded sold down there. So that's just something to keep in mind too. There is that ability to accommodate those types of situations. And a lot of times it's great to look at, but it is often going to be overlooked. Husband-wife groups, we can write them. However, they need to have one part-timer, or they need to have another, full-time waiving employee. So I can't just do an employee and their spouse. They have to have somebody else on payroll. They don't have to take the coverage, but they do have to have either one part-timer or another full-timer waiving. We can write that and accommodate that, no problem whatsoever. That's obviously a very common scenario that comes up. We can accommodate 1099 employees. That's obviously, a niche that we've been able to fill for quite a long time. I am going to say, just because we say that they're 1099, we're still going to require them to show us the 1099. If they were hired that year, there always has to be an employer-employee relationship. We are going to ask to see, okay, can we get a copy of a deposit or a check, something from that business, that employee, to show that they are legitimately employed. So I just want to set that expectation correctly. Flexible participation. This comes up a lot, and you guys will find that a lot of businesses get put into these situations where they're boxed in and they feel like they don't have options because of the participation rate, or it could be a variety of things. They've hired too many people. Maybe their wages aren't competitive enough. They're trying to figure out how do we get around this or circumvent this issue. That's exactly the type of group that we could probably provide a solution with. It just depends on what exactly their issue is and the steps we need to take it to fix that or to help provide them with that answer. Carve-outs, a lot of you guys may not be familiar with it, especially if you're not in the group space, but under 𝗺cie, essentially this is going to happen a lot in the restaurant industry, we'll say. You can make it so that the managers of that restaurant, right, are the only eligible employees, right? We're going to carve out everybody else that's at that business besides people that have the legitimate title of management, right? So all the bartenders or waitresses that may not be making enough to even afford it, we can fix that participation issue very easily and just make it so that only the managers are eligible. All of the others are going to be ineligible, right, under this carve-out guideline, and we can get around the participation issue that was stumping them with all the other carriers out there. Under 𝗺cie, the employer can set the full-time hour threshold. There are certain states that have a little bit of limitation there, but for the most part, they're always going to be able to go between 20 and 40 hours. Obviously, under ACA, it's going to be, the default of 30 hours is always what's going to be assumed, and that's averaging 30 hours over a month, just so everyone's aware. Valid waivers. I have the normal participation guidelines for us on the slide. 50% of the full-time eligible count. So if there's 20 employees at the business full-time and 10 are enrolling, that's an example. You'd be meeting participation since you have 50% participating. Or, and this is always an either or 75% after valid waivers are removed from the eligible count or the full-time eligible count. So let's just take that same example. Let's say there's 8 out of 20, right? We're under the 50%. That's when the waivers will come into play, right? So if they have other coverage, right? Other major medical coverage, I should clarify that. They have individual, they're on their spouse's plan, Medicaid, Medicare, TRICARE, right? Those are all valid waivers. So what would happen is in this scenario, let's say all 12 of those employees that weren't interested in enrolling, but the 8 are, if they all had valid waivers, now your participation's at 8 out of 8, which is 100%. So just to give you guys a quick example of how that works and how you would do that math. We can accommodate low participation, 25% of total full-time eligible. However, I would look into the other ways before we go down that path, just because there is going to be a markup and it's going to vary from group to group and state, essentially. Other niche is really anybody looking to implement cost containment or save money. With the way fully insured is now, a lot of it is coming back down to the almighty dollar, and the only way to really save, or the only alternative they have, right, is either to disband the group plan altogether or to look at these underwritten or level funded options. So this is not going to take a ton of time on this, but this is just some of the network options that we have. So we can use, obviously, Aetna ASA. We can use, Aetna, the point of service, Cigna, 𝗁𝗵𝗶𝗀, Cigna Local Plus, which is a great way. It is a smaller network, but it obviously can save upwards of 20% easy. Regional networks that are marketed under Valens, we will get into those if and when that comes up. We can always turn all these plans into an EPO, meaning we can make it so that there's no out-of-network coverage. With the recent implementation of the No Surprises Act, a lot of people, especially ones that are savvy or that have been in this industry for a while, or this side of the industry, they'll know that a lot of these carriers, especially on the fully insured side or the 𝗶𝗀s, they are offering a lot of plans without out-of-network benefits, right? I tend to want to stick with the best value just because that's usually the best way to go. You want everyone to have that peace of mind. But if we want to trim 5%, we always can do that, and we can turn any of these networks into an EPO. So I just want to at least bring that up to everybody and make sure everyone's aware of that. So this is something that we're going to go through in more detail probably on the next one, but I am going to go through this to a degree just so you can understand what I was talking about with the transparency. So Here we have a sample quote essentially, right? And you're going to see all these different boxes: traditional, advantage, core value. So the core value is going to be the reference-based pricing options. Advantage, that's the EPO options. And then traditional network arrangements is just traditional in and out of network. Now, what this first line means, specific limit, this is the stop loss or the amount one person, one belly button on the plan can take out of this claims fund. Oh, hold on. Out of this claims fund, right? Now, what I'm going to do is, that's not going to make sense yet to you. So what I'm going to do is I'm going to go down here and I'm going to explain, here's the total I was talking about earlier, right? For this plan, $8,698.85. Traditionally, you're going to be looking at this if from a fully insured perspective, these three boxes above that 8,698, those aren't going to be included. The employer and the broker are going to assume that the insurance company is lining their pockets somewhere. They don't know how they're getting to that total, right? But they know that there's obviously margin built in. Here, right, we're being transparent about how those dollars are being spent. And a lot of times the employers are going to appreciate this. That way they can try to get a better handle on what's going on and how do we, implement some of these cost containment measures and save money. So as you can see here, the stop loss premium, that is us as the stop loss carrier, right? That is going to be $4,814.12 out of this $8,698. The admin, sales, general expenses, right? So that's our TPA, all the service, web portals, their app in the app store, the adjudication of claims, etc. And the agent commission is also included in that bucket. That is going to be that portion of it, right? So all three of these boxes are going to accrue to this 8,698. The part that makes this go around and operate as a level funded or a partially self-funded plan is this claims account funding, right? So this box here, if you multiply 1883.25 cents by 12, and the 12 is coming for 12 months of the policy, you're actually going to get this $22,599, okay? And you'll see that it's phrased as the annual aggregate limit. That's fancy language for the employer's claims fund. You heard me talk about a refund potential earlier. This is where that refund potential is coming from. Whatever remains in this at the end of the year and after the runout period's been satisfied, they'll get a check back for 50% of this. So, and that really is going to be after the runout period. So it should be in month 20 from day one of the policy. Let me just give you an example. Let's say there's no communication with the broker or the group, and we're trying to figure out how do they want this money sent back to them. What's going to end up happening is we're just going to end up cutting a check if there's no dialogue, and we're going to send it back to the employer. And the employer typically is going to want to keep that money in healthcare just to avoid taxes. As long as they keep it towards a healthcare expense, then they're not going to have to incur that. I'm not a CPA, but it's definitely good to ask them at what point that would come up and be an issue. I was always told it was 6 months. So a lot of times what employers are going to do is they're going to take that surplus or that money that they've gotten back on their plan, right? And a lot of them, they're either going to use it for HSA contributions, or they're just going to roll it over the next month's premium. So you heard me talk about composite rates earlier, right? This is an example of composite rates, the 384, 981, 750, and 1270. Now, the one thing I am going to mention on here too is that there's certain states out there, like Michigan, for instance, on fully insured, they don't require a employer contribution. Okay. In Illinois, they only require a 25% contribution for the small group, right? On these, since they're level funded and to basically adjust for the adverse risk or the adverse selection that comes with this, you're always going to be mandated. It really doesn't matter which level funded carrier you're talking to, but the employer needs to contribute 50% to that employee only premium. All right. And that they don't have to contribute to the employee spouse, child, or family. They can if they want. It's their business. They can operate those contributions how they see fit. But the only thing that really needs to be taken into account here is they have to pay a minimum of 50% of the employee only rate. Okay. And again, we can go through this. I've always found that, especially not when we're not reviewing a group in particular, this can be a little too abstract. So Tammy, myself, and everybody at IAD, we're more than happy to jump on, these quotes, go through it with you. That way you are comfortable and you can find the success that will inevitably come. So please lean on us for anything. I know that some of this isn't going to make sense right away. It will make sense once you compare it to a real world example and you can see the savings. So if there's questions on any of that, let's save it and we'll circle back to that at the end here. So now I'm going to go over additional plan enhancements. You heard me talk about cost containment. So in every single one of these plans, we have what this is called is 𝗵𝗶 for employers or 𝗵𝗶 caregivers. Okay. And what this is here for is essentially we wanted to empower or we've noticed a trend, right, in the market. We wanted to give employees an option to fix some of these little nuances that can inevitably lead to issues, right? And some of those issues could be, let's say your parents are staying at your house, they have to take medication, you're busy, caught up at a meeting, you can't get home in time to administer that medication. You could call a 𝗵𝗶 caregiver, right? And these people are triple background checked, and you could have them go over and administer that medication. Likewise, I use a healthcare example in there just because that's what it should be used for typically. However, that's not really, you're not boxed in for that. It could be used for pet help. Let's say same thing applies. You need to let your dog out. You're stuck in traffic. You can't get home, right? You could call 𝗵𝗶 caregiver. They could send someone over to the house, let the dog out, etc. The first time 𝗵𝗶 caregivers is used, it's going to charge you 1 hour. You get 10 free hours with this on every plan, right? From there on out, though, after that first time it's used, it's going to be prorated by the minute. So for the remainder of the 9 hours that the employees have, it's prorated and will be, billed as such. We've seen that there's a trend, right, for employees to go back and, get more time. You can buy more time for this program that is available. So I do just want to make everybody aware of that. 𝗁 Health. So this is a great product. This is actually, I believe they were the #1 healthcare company last year, voted or recognized as the #1 healthcare company. So this is addressing an issue that is really prevalent with the medical industry, essentially. There are a lot of these surgeries, right, that are getting done, and usually it's going to be for musculoskeletal, that are getting done where they're really not necessary to get done, right? For instance, like a 32-year-old with, they have a sprained back and they're getting back surgery. I only bring that up just because I had a similar situation, and I had one doctor trying to push me towards getting a back surgery, and then I had another one saying you'd be crazy to do that, right? There is money to be made here. So what ends up happening and what we found is that up to 40% of these, musculoskeletal surgeries are unnecessary. So when you go through and the employees take advantage of this plan, right, or this product that's on our plans, they're going to be able to get, additional value or additional expertise, to go out and say, how can you address this problem without getting that back surgery that may not be necessary, right? Or how do you address this problem for your knee if you don't want to go through that surgery, or if you're confident you can build it back up? So this is something that goes directly into the P&C side and the workers' comp. This is a great product to have embedded in these plans because it can cut down on that, which inevitably is going to save the business money in the long run, not only on premiums, but on their utilization for the health plan, right? So that is the name of the game with some of these value adds that we include on here. So it's a 0-member, copay for the initial evaluations. $0 copay on all the lumbar and knee. So the rest of these are all going to be covered at subject to deductible co-insurance, which is pretty straightforward. And this is going to be included on all plans, but it's also included on all of the reference-based pricing plans as well, obviously. So another great value add that we have on here is the Cancer Coach by 𝗁. Obviously, stress can add a lot to, an already pretty heavy burden when someone has cancer, right? What we found is that it really is beneficial for them to talk to a cancer coach or a 𝗁 Health, right? And figure out exactly what can I do, or what are people in a similar situation doing that can help increase the likelihood of beating this, and then really trying to maintain their well-being too, right? From a mental standpoint. So that is something that I would implore everybody to use as well, because anything to alleviate some of the stress and that, you know, the added stressors of this is going to be beneficial. So quoting, implementation, sale. So this is going to be pretty, I'm going to breeze through this just because I don't want to get too short on time and I want to answer questions. But preliminary quote, we've always been the quickest in the industry, 24 to 72 hours. Technically, you could always reach out and say, hey, you know, I need this by tomorrow because I have a meeting. I'm sure that we can get that done for you. It's not a big deal there. Medical underwriting, it's 2 to 5 days for firm and final rates. It really depends if there's any missing information that was, you know, left off the applications. And then submission, it's 2 to 3 days to get it issued or approved by underwriting. 3 to 7 business days once issued is when they're going to get their welcome email with their temp ID card, etc. I am going to say I have this changed to 3 to 7 for the welcome email, just because in fourth quarter, you're going to see all the carriers' timeframes get pushed back a couple days. Typically, it's 3 to 5 business days. When you start getting to 1/1 effective dates, that's when you're going to start to see these be a little bit longer, just because of the volume that everybody is dealing with. So let's define risk, because obviously we talked about, you know, medical underwriting and getting rates that are proportionate to the risk. What is, you know, a big deal? What's not a big deal? For those of you that focus on the under 65 market, right? There's a McDonald's on every corner. So in group, it's not the same underwriting process. We anticipate high cholesterol. You know, we know there's going to be some diabetes. We know there's going to be anxiety, high blood pressure. That's par for the course, right? And it also depends, this also depends on the group size, right? How much premium is being collected to offset the risk that is on that business, you know, in that risk profile of that business's employees. So this just gives you a good idea of some of the things that could be high cost or knockouts. When I say moderate to knockout, you're talking about a 5-man group, and it has, you know, some of these, you know, $20,000, you know, a month. That's probably not going to be a good fit, and ultimately we could decline to quote that altogether, or the rates will be so high that you'd probably wish that I had declined to quote it, just because it's not going to look very great. So what we need for quoting, right, is just the employer level info, group name, zip code, SIC code, or their industry. If you don't know the exact SIC code, that's fine. Like if we know what the industry is, it's pretty easy for us to ascertain this. I've done this a very long time. It is going to be, you can find it online pretty easily. So employee census, right? Ages or dates of birth, gender, elections, dependent info, zip codes, prior carrier info, and really any info that you think that you have on hand that could be beneficial for us. Plan designs, if they're not interested in HSAs, or if they just want to look at HSAs, any of that always helps. I don't need the prior carrier info. Just to be clear, it's just good to know where everything falls and know what kind of benefits or what solutions they're looking for. For the underwriting process, you're going to find out, and this is something that a lot of the other carriers echo too, is that, you know, for 2 to 50 enrolling, apps is probably the best way to go about underwriting. We have an online link that I can help, you know, that I can help run and organize for us. That way we're not herding cats, or we're herding cats more efficiently, and there's less time spent on your end. That way you can spend it selling, while I can give you the updates and let you know. If we're waiting for 10 apps, I'll let you know, hey, there's 8 apps in, we're just waiting on these last 2. Eventually you guys are going to get to the point where you're so proficient in this, and that you know you kind of want to avoid street rates, that you'll just take people straight to underwriting, because you're already going to know that any underwritten plan should be much more competitive than the fully insured options available there. Then we can do a simply underwritten approach, or a census underwriting approach. I'm just going to let you know, we're confident in ours just because we were the first carrier to do this in 2014. And we have some backstops in place that we've built over the years. But I will tell you that, you know, if the group doesn't want to look at apps, or they don't want to complete apps, and they just want to look to see what it could be, we don't have to go to apps right away. If they have 20 enrolled and it's not a virgin group or a new business offering health insurance, then we can take their renewal, we can take the census, we can take their, plan designs and the SBCs along with the disclosure form, and we can underwrite it that way. I am going to tell you, we'll probably find the most success with the applications just because of the transparency of the information, right? We know that that's more sound, and we have things in place to obviously check on the background. So I will send guidelines on that as well, just so that everybody has that, but just keep an eye out for that in the future. I know that Tammy and I will get that all out to you guys. So for implementation, and again, kind of getting ahead of ourselves here, but at the same time, it's good for you guys to know the most recent state quarterly wage and tax or unemployment report. That's typically going to be required, right? And that's just to check and see that everyone is a legitimate employee. We're going to see that the taxes are being taken out and they're being reported to the state. Now in fourth quarter, technically, as long as they have a prior carrier bill and it's not a virgin group, we're not going to need that. The tax and wage, that's just because with the volume, it's too much information to review and go over. So as long as they have a prior carrier bill, we will not need the state quarterly tax and wage for 10/1, 11/1, 12/1, and 1/1 effective dates. Plan election and the final, enrollment elections. The one thing I will say is that since these are composite rated, the final census matters, right? So if we underwrite it and there's 20 employees, or there's, let's say there's 18 employees on there, and then it drops down to, 15 at implementation, that's better for me to know when that's happening in real time, just because the rates are going to change a little bit, right, for the enrolling census, because the demographics could change, the risk could change, et cetera. It's my job to keep those rates as close as possible. That way everything is smooth and it goes through without issue. Welcome email includes videos, key contacts, group temp ID cards, instructions for where to locate and find everything on the web portal that the employer or the broker needs. Allied benefit is our TPA. They obviously, we've talked about this in detail, so I don't think I'm going to need to go through this, but I will keep these slides. These are just some of the services that they have out there for us and that you'll be able to utilize. Again, just an extension of what I just talked about. There is, like I said, though, earlier with transparency, you can look and see where their claims fund summary, where their claims fund is trending. How much of a refund potential are they expecting at the end of the year? All of that's available to you in real time, right? All of the claim reports, claim fund summary reports, that's all available to the broker in real time on the portal, which allows you to make those educated decisions I had discussed earlier. And we also have an account management team. They're going to be used really for, reissues. They're going to handle reissues. And then anything escalated, they'll be there. They'll send you a introductory email once we have the case issued. That way you have their contact information as well. I tell everybody that I work with, and I've done this a long time, that if I ever need to get pulled in or involved, that's totally fine. My name is on the paperwork just like yours, so more than happy to help facilitate any solution that needs to be made or come up. And again, quarterly newsletters, they'll be in contact and they'll reach out to you as we're approaching the renewal too. That way everything is, run smoothly. You have everything or all the information you need to be equipped, and that everything goes pretty quickly and pretty easily. You'll find that a lot of them are pretty well versed, and they've been in the industry for a long time. So it's a very good team and they're very accessible. And then I'm wrapping up here. Last but not least, we have online portals for adds and deletes. Okay. I would implore everybody to use this as much as they can, just because it does make everyone's life easy. We can send in additions in terms, by hand too, if they want to fill out a termination form, or if they want to fill out an employee application, we can do that. But this is much more simplistic from what I've found, and especially in this day and age with the advent of all the different technologies, AI, et cetera. And we'll supply you guys with the user guide that comes with the account management email as well. So I know that was a lot of information. So let's open this up for questions.
Okay, it does not surprisingly look like we have questions right now, but I just want to be sure to tell everybody we understand this is a lot of information to come in a short 45-minute. That's why we're going to have additional, if there is interest and you get contracted, we're going to have an additional training program for agents in the next couple of weeks. In the meantime, please reach out to me with questions. I know a lot of our agents will be seeing this on recording, so please feel free to reach out to me. My email is listed on this slide as well. For any questions or concerns you may have. This is a lot of information at one time, but we're very, very excited we've had a lot of requests to bring group products into the space here at IAD. So we are doing that. I see the questions popped up, so please continue while I'm kind of going through things. One thing I really like is that with this level funded plan, employers have and employees have the ability to engage in their own health, with the additional programs that they have, like 𝗵𝗶 and the cancer program. If people are more engaged, they understand their healthcare more, they tend to have lower costs. And that's more savings for the employer. And that helps employers actually want to offer this when they never have before. So it's a great product to add to our little quivers that we have as we talk to people. So I am going to check questions here real quick. When are renewals completed? So Spencer, is this a calendar year, or is this for agents to understand kind of how it works on this side?
So the employer it's 60 days. So you'll have the renewal numbers 60 days out from the reissue date. And then there will usually be some additional dialogue with the account manager, obviously, just to see, are there new employees there? Are there employees that have been terminated off of this? The one thing that comes up on this a lot is that, especially in the first year, claims don't start trickling in, right, for about 30 to 60 days. And then when you have to start calculating the renewal about 90 days out, right, to get it out in that 60-day time frame, what happens there is that you've got basically 4 to 5 months of dead data, right? So your odds, you always are trying to keep these businesses, right, for at least a couple of years, just because that first year, there isn't a ton of data besides what we have from the underwriting standpoint. And I can see some other questions coming in. Technically, it depends on, how many plans can be offered per group. So with adverse selection, we can do 2-3 plans. It depends on the plan, the actuarial value between those plan designs, though, too. Because there's going to either be a 2 or a 12% rate up, depending on those two. And that's for adverse selection. I am aware that there are obviously carriers out there that say, okay, you can choose up to 10 plans. They're losing money on that. There's just no other way to put it, because what you're going to have everybody do is go to the plan that's richest, right? That's going to overutilize. And then you're going to have the rest of them all take the cheapest HSA possible. Typically, that's how that plays out. So I think I covered that. Okay, it looks like you had one answered. Are there any other questions? And we can stay on here. I blocked out enough time if there are any more that I can address.
Right. Yes, absolutely. If you have questions right now that we can answer, we are more than happy to in the next couple of minutes. And again, I'll follow up with everybody. And I know there's always questions that come later, or somebody may be watching the recording. So by all means, reach out to me. If I cannot get you the answer, Spencer will. I'll let you know, I will say this does take, little chunks. It takes some time to just get familiar with it. It's a little different than what most of us know. Granted, we do have people, agents who are in the group space currently, but this is a big push for us to offer it to people agents who've only been working in the fully insured or not at all in the group market. Just something additional to add in, because we're constantly always running into people who have small groups. We're running into employees who say, my employer doesn't offer coverage. What can you do for me? And sometimes ACA is not affordable for them, but maybe we can reach out to their employer and see if we can get them into a level funded group or something of this nature that can help be good for everybody. All right, I do not see any additional questions coming through. So again, feel free to reach out to me either by phone or email if you do have questions after this today. And I'll be reaching out, and then we will be scheduling training for the agents who sign up in the next couple of weeks. I think we have some tentative dates at the end of September. And thank you again, Spencer, for your time always. And, you know, we're going to help you get through these. So don't feel like you're going to get contracted and then you're going to have to do this all on your own. We will, between ID and Allstate, we will be there to help you get through your first few groups so that you feel confident. There's never going to be the same situation twice, probably. So,
Yeah.
you know, we understand it's going to take everyone a little time to get used to it. So we want to be here to support you.
Yeah. Happy to help however I can.
Thank you. All right. Thanks, everybody. Again, have a wonderful day, and we look forward to speaking with you soon. Take care.
Thanks again. Appreciate everyone's time. Take care.
Thank you. Bye-bye, everyone.